Good afternoon for the final session of this wonderful conference. I'm Harold James. I teach here in the History Department and in SPIA, and I'm also the director of the program in Contemporary European Politics and Society. And it's an enormous pleasure for me to be able to introduce Hyun Shin, who comes to us from Basel, where he's the chief economist and the director of the Monetary and Economic Department at the Bank for International Settlements. But he's also an old friend of many of us because he was in Princeton for a very, very long time. He's the author of really very, very seminal papers on financial stability, on banking stability, and in the particular that I appreciate very much in the story of the financial structure that is at the core of the 2008 financial crisis. And that's in fact, my first memory of Hyun is really in 2007 when nobody knew what was going on. And Hyun explained it so beautifully and so brilliantly in terms of the relationship of the accounting balance sheet stories of American and European institutions and the interrelationship between the two. And so, in a sense, I think it's wonderful that he's developing these themes that we were hearing about so much yesterday, thinking about the way in which balance sheets are actually at the core of the way in which we should be thinking about the financial system. But he left us very sadly to go to Basel. But Basel is in a sense at the center of all of this. And if you look at the BIS annual reports, or if you walk into the BIS building, on the front of the annual reports, there's a statement about the aims of the BIS, promoting global monetary and financial stability. And that's also put in a big kind of board at the entrance to the BIS, where from one side you see that message, and from the other side you see all the flags of the member countries. And so I wondered whether Hyun can help us understand that question of global monetary and financial stability at a time when people are thinking of competitive games and a zero-sum world. And you know, when I think we were thinking about this in the 1990s and the 2000s, we thought of global financial stability and global monetary stability as a general good, as a public good. But in a zero-sum world, it's also quite conceivable that some countries can think that instability in other countries is a good from their point of view. And so this is a more fragmented world. Hyun's going to talk to us about the rewiring of the global financial system since the financial crisis. And in that regard, you know, I have to say I'm slightly worried because it seems to me a bit like the theme that we got from Ken Rogoff yesterday, that Ken's great book occurred the first great book occurred at the moment of the financial crisis. And now he's produced another book, and we're very worried about that. So I want to ask Hyun how worried you are about this, and how worried you are in particular about two things. One is the question of how much we can really know in terms of these accounting principles and the balance sheets, and how much data is not there, how much is off the radar screen, either in countries where we don't know enough about the data, or in financial institutions where we don't know enough about the data. And we've got now all kinds of worries about the private credit market, and Blue Owl is figuring prominently in our nightmares. So, you know, what don't we know that we should know? And the second question is something that came out of some of this morning's discussions. Supposing we start to think that we should restrict capital flows or tax capital flows, what does that do in terms of your vision of global monetary and financial stability? So Hyun, thank you so much for coming, and I'm really looking forward, we all are looking forward to your remarks. Thank you.
Well, thank you, Harold, for that very nice introduction, and it's fantastic to be back in Princeton, to see so many old friends. As Harold said, what I'm going to be talking about is the post-GFC rewiring of the system. And there are several strands to this discussion, but I think one thing has already been mentioned today, which is that if we go back to the period before the crisis, and we looked at the lending to the private sector versus lending to the government, the lending was very much being driven by the credit to the private sector. And so, as Shebnam showed yesterday, some of it, a large part of it is corporate debt. But in the period before the GFC, of course, a lot of this was mortgage lending. So this is just a normalized series where we put both charts at 100 and see just a relative growth. What we saw after the crisis, of course, and this is what Ludwig described, was that there was a retrenchment of the lending to the private sector, and instead it was government debt that grew faster. So there was a kind of an overtaking, and that trend was just amplified further due to COVID. We had huge fiscal impulses during COVID, so that now the red line is much higher than the credit to the private sector. Now, as Harold has already suggested, we're living in a globalized world, and although we talk a lot about economic fragmentation and the fragmentation of trade and so on, in terms of the financial system, we are more connected than ever. And this is a chart that shows the portfolio bond flows. So think about government bonds, corporate bonds, other types of fixed income securities, and just ask what has been the change in the holdings between 2015 to 2023 across the major regions of the world. And one thing that really grabs you, first of all, is that the large flows are mainly between the rich economies. So in particular, from Europe to the United States. Now, these are gross flows, and although the big arrows are coming to the US, of course, there's also the arrows leaving the US. But I think one thing that really does, that really jump out from this chart is that if we were to impose Tobin taxes and restrictions on capital flows, at least in the first instance, it'll be the rich economies. In particular, it'll be Europe, which will be affected the most. There's, of course, the Asian EMEs. This is where China is, and that's also a big arrow. But it's comparatively smaller than the arrows coming from either Europe or the other advanced economies. Now, what's happened in terms of the composition? If you look at the official flows into the US, so in particular the holdings of US Treasuries, the official sector holdings has pretty much plateaued. And it's not really gone anywhere since around 2012. And it's instead the private sector holdings that have really gone up. And I'll say much more about what's behind that blue part. The other theme, which is going to be very important, at least for the first half of my talk, is the fact that given the global nature of these flows, the currency dimension is going to be very, very important. Because if I'm a European investor, if I'm a European pension fund or a life insurance company, I have obligations to my beneficiaries or policyholders. And so I will need to be able, I will need to hedge any currency risk that comes from holding US dollar securities. And so being able to hedge those currency risks are going to be absolutely key. And this is where the global banking system comes in, because it's the banks that provide those hedging services. And the most important instrument here are the so-called FX swaps. And think of FX swaps as basically a way to borrow dollars. But you borrow dollars by pledging another currency as collateral. So here's an example of a European investor who wants to invest in a US dollar security. What you do is you go to a bank and say, I would like to borrow some dollars because I need to have some dollars in order to buy some US securities. Please lend me some dollars and I will pledge some euros as collateral. And in the first date, the bank would provide the dollars together with the promise that these dollars would be repaid at the end of that contract. And the repayment, of course, is going to happen at a price that takes account of any interest rate differential, so the so-called forward rate. So remember, a swap contract like this is essentially a way to borrow dollars. And given the large portfolios that have come into the US, what this means typically is that the financial system as a whole is typically very short dollars. How large? Let me just explain how this would work. So here is an initial balance sheet. Here's a euro area investor. It's all euro denominated to begin with, but if you enter into an FX swap, you have, instead of euros, you would have some dollars on your balance sheet as cash. These are deposits at a bank. But then that's counter weighed by these forward obligations and forward claims. And then with the dollar cash, you would then buy the US Treasury. So that would be a hedged position where the only risk that you're bearing is going to be the natural US dollar price risk, because any change in the exchange rate will affect both your assets and your forward liabilities. Now, these positions are very large, and one of the things that we do at the BIS is to publish a semi-annual total of how large these positions are. And the latest number is $130 trillion. These are the outstanding amounts of FX derivatives. More generally, the lion's share of this would be FX swaps and forwards, just in particular the forward obligation. And the important thing to bear in mind here is that the story that I just told you of the euro area insurance company is captured in that red segment. These are the swap contracts, the FX derivatives contract between the dealer bank. The dealer bank is always on one side because it's the dealer banks that actually provide the data. The question is, who is on the other side? The yellow part is the interdealer. It's the dealer-to-dealer part. The blue part is the dealer to a non-financial institution. So it could be an exporter, someone who wants to hedge a trade transaction. But it's that red component, which is the financial use of FX derivatives. And that's basically tripled since the GFC. Of course, anything that can be used for hedging can also be used for speculation. But there's been a very interesting phenomenon, actually, especially with regard to what happened in the financial stress of last April. So suppose that because the dollar has been strengthening, because of the very high cost of hedging, because you're borrowing dollars in order to hedge, but short-term dollar rates have been high, so hedging costs have also been high. So that has dissuaded some of the investors from hedging. So one of the things that we know is that hedge ratios, in other words, the amount of dollar security holdings that you would hedge using an FX derivative, that has been eroded. Well, that had been eroding up to that April episode. So here's a case of an unhedged holding of a US security, but then you're concerned about any further falls in the dollar. What you can do then, you can just enter the FX swap market again, enter a swap, but then rather than buying a US security with that US deposit, you simply sell it in the spot market. Then you've ended up with a hedge position, but the act of selling that amount of dollars in the spot market, of course, puts downward pressure on the dollar. Whereas before, you were actually buying a US security and borrowing that. And so those two sides actually are actually offsetting. And we think part of the decline in the dollar that we saw in April was accounted for by this type of trade. The other way of doing it, of course, is to go to a bank and say, please give me the forward obligation only, but then it's the bank who would need to hedge, so that it's the bank that is selling the dollars. The issue with the swap market is that these are short-term instruments, mostly 1 month or even shorter. This is basically the same chart that you saw before, but broken down into maturity. We have a less than 1 year bucket, and then longer-term buckets on top of that. The lion's share is below 1 year, and typically it's going to be even much shorter. And let me come back to this at the end, because even though I may hold a US dollar security, what I've done is to borrow dollars in order to hold that security. And so I have a short-term debt in dollars that I may need to repay. And if I am unlucky and I need to repay that dollar debt at a time when there is limited access to dollars, because there is a liquidity stress event, for example, then I have to join the scramble with everyone else who is, who had borrowed dollars. But let me come back to this at the end. The other element that I'd like to just to highlight is another aspect of this rewiring, which is very much on the deposit versus the long-term holding side. So let me tell you a bit about global dollar deposits. So what has that done? Well, to tell that story, I need to start with just some very simple diagrams, the kind of balance sheet diagrams that Harold mentioned. Suppose that we start off by assuming that most of the government bonds in the economy are held by the non-banks. So, think about insurance companies, they could be households, pension funds, and that's indicated by the yellow segment. And the banks are not holding any bonds in this example. What happens to deposits, in particular that blue deposit segment, when the central bank purchases government bonds from the current existing holders? Well, the non-banks cannot deal directly with the central bank, because the central bank only has the dealings with the banking sector. But the banks can act as a dealer on behalf of the non-banks and sell those to the central bank. So what would happen is the bonds end up on the balance sheet of the central bank. The non-bank has fewer government bond holdings, but the commercial bank is intermediating between the central bank and the non-banks. So if you look at the commercial bank balance sheet, the reserve holdings go up because the central bank has paid the commercial bank. And so that's the increased reserve holdings. And turning around to the sellers of the government bonds, they're providing more deposits. The deposits are the proceeds that go to the sellers of the government bond. So when you see so if you just look at this part here, the central bank holdings of government bonds and commercial bank deposits should increase pretty much 1-for-1. And if we look at that chart, which is the green line is the Fed's total assets, and the black line is the amount of global dollar deposits outstanding. So it's not simply in the US, it's the global total. I'll give you a breakdown shortly. I'm using two different vertical axes here, so it's not on the same scale. But if you look at that chart, you do see that when the Fed's balance sheet is increasing, you also see an increase in deposits, exactly as we would expect. But the interesting phenomenon is that even as the Fed shrinks its balance sheet, the deposit holdings have not come down together. In fact, the deposits globally are higher than they were at the peak of the COVID period. And if you also look at 2019, when there was an earlier period when the Fed was shrinking its balance sheet, global deposits kept increasing. So this raises a puzzle, and this is the second aspect of the rewiring that I like to just put on the table for you. But before we get there, let's look at the global deposits broken down into deposits at banks in the US, which is this chart, and deposits at banks outside the US, which is the blue. And as you can see, deposits outside the US are actually pretty substantial. It's around 30%. So 30% of dollar deposits around the world are held at banks that are located outside the US. If you ask which jurisdictions, well, here are some. If you break that into these different jurisdictions, it's mainly the financial centers that are really very much at the core of this. So this fits the story, on the way up. It makes perfect sense because U.S. Treasuries are held everywhere. And so when the Fed is buying U.S. Treasuries, of course, the accounts of the sellers are being credited all over the world. And that accounts for the increase in the dollar deposits in the UK, in Hong Kong, Canada, etc. Again, the interesting thing is, yes, I think you see a little bit of a dip in dollar deposits when the Fed starts to shrink its balance sheet, but it hasn't really progressed to the same extent. You see that deposits have continued to go up. So let's go back to this diagram. So this is after asset purchases. Central bank has expanded its balance sheet. There are lots of reserves in the system, and there are lots of deposits in the system. What would be the consequence of shrinking and, by not absorbing, there'll be more treasury securities coming onto the market. So what is the consequence of the Fed shrinking? Well, if we saw the non-banks on the right come in and buy, well, then we would go back to the initial position, because then the deposits would shrink, the reserves would shrink, and the central bank's holdings of government bonds would also shrink. But the fact that deposits have not shrunk means that something else must have happened. And the question is what? Well, clearly the Fed has decreased its asset holdings. So who is holding these treasuries? So that's the question. And the question must be, if we leave the commercial bank balance sheet as they are, there must be some other holders of these government bonds. And these other holders must have the property that they're holding government bonds on the asset side, but they are receiving funding from the banks on the liability side. So what are they? Well, I think here is where the story becomes very interesting, because we know that one thing that has been very prominent recently is the activity of hedge funds, in particular the relative value hedge funds. If you look on the left-hand panel, this is the U.S. Treasury market, the holders of the U.S. Treasury market divided into domestic private, foreign private, foreign official in yellow, and the central bank in blue. You see that foreign official sector holdings have shrunk, as I showed you before. And of course, the Fed is decreasing its holdings. So those two components, the yellow and the blue, they've been shrinking. But it's the domestic private and the foreign private that have been increasing. And here, foreign means outside the US. So, and this is purely a locational issue. If it's essentially a US hedge fund, but it's domiciled in the Cayman Islands, that is treated as a foreign entity here. On the right-hand side, more generally, for advanced economies, what we see is that domestic central bank holdings have shrunk, but the non-bank holdings have increased. So let's dig a little bit deeper. If you go to the OFR webpage, they actually have a very nice chart. The Office of Financial Research, which is a very, very good data provider. What you see is that for US Treasuries, the holdings of hedge funds have become very large, become very important. So it's gone, so that's the pink part, as well as the non-US sovereign debt, which is the blue. And together it's around 6.5 trillion. And that's grown very rapidly from, well, actually half of that. And how do they finance these holdings? Well, it's through repos. You pledge, you take the treasuries to the bank, and the bank will lend you the money, and you can pledge the treasuries as collateral. Another way of borrowing from the bank is through its prime brokerage operation. So these two financing sources are very much coming from the banking sector. So that story that we've just told with the financing must be coming from somewhere. The fact that the banks have not shrunk their balance sheet must mean that it's the banks that are providing that financing. Now, it's not just a US story. If we look at what's going on in the euro area, it's, again, the pink bars. It's the hedge fund holding of the government bonds in the euro area, as well as in Canada. The relative value trades that are active in the US are also active in Canada. And the amount that are actually taken up by the hedge funds in Canada are actually very substantial. Now, what enables all of these hedge fund holdings, of course, is high leverage. And because it's on a collateralized basis, the question is, if I have $100 worth of treasuries, how much can I borrow against $100 worth? The difference between how much you borrow and the value of your securities, that's called a haircut. And a haircut is a constraint on how much leverage you can take on. So it's basically a constraint on leverage placed by the creditors on the borrower. And so if the haircut is 1%, then you need at least $1 of equity in order to finance $100 worth of Treasury holdings. So the haircut is the reciprocal of the maximum leverage you can hold. One of the really amazing things that's happened is that the haircut has been getting lower and lower and lower, to the extent that around 70% of repo transactions have a zero haircut. In other words, the creditor is not imposing any constraint on the leverage that you can take on. So on the left-hand side, if you compare the euro and the US dollar, the proportion of the zero haircut repos have been very, very high. We published a piece recently that also calculated the effective haircut on the repo positions of hedge funds. And it's the chart you see on the right-hand side. So for the large hedge funds, the effective haircut is really very, very small. So without too much exaggeration, the creditors are not imposing much of a constraint on the leverage. The only constraint is actually internally imposed. It's the risk model of your firm, which is essentially the only constraint on the leverage that you can take up. So just as an interesting exercise, if you superimpose the US hedge funds repo borrowing on top of the Fed balance sheet, you get this chart here. So pretty much for every Treasury security that's been sold or been allowed to roll off the Fed balance sheet, there's been this take up by the hedge fund sector. And of course, this is only a small part of the story because that's only for the US. If you go to the European markets, there's also a very substantial US dollar repo market within Europe as well. So this is from the so-called SFT data, the security financing transactions data in Europe, where a very large chunk of the repo transactions are actually in US dollars. So this goes to, Harold, your question, what might be the risk that's inherent here? And let me combine it with the earlier chart on the maturity of the FX swaps. Because it's the same dealer banks that are providing the FX swaps as are providing the repo transactions for the hedge funds. So these are very short-term instruments. FX swaps are off the balance sheet. It doesn't appear on your it doesn't appear as part of your total assets. It's off the balance sheet. It doesn't count towards your Basel III leverage ratio, for example, but it definitely is a part of your risk budget if you're a large dealer bank. And if something happens in the FX swap market, you will really think twice about rolling over swaps in such a big way. But then that's exactly also the same risk budget that is underpinning the repo transactions that you're providing as well. So FX swaps and repos, although they're very different animals, essentially are using the same risk budget. And so if something happens in the Treasury market, the FX swap market is also going to be affected. And we saw that in the GFC. We saw that again during the March 2020 stress. And we've come close, once or twice, in between those episodes. So in this rewiring of the financial system, I think what we can say is that it's the government bond market which is really at the center. The GFC was all about mortgages and lax lending standards, high leverage of the commercial banks, et cetera, et cetera. But now we are focusing the attention much more on the government bond market. These are safe assets, but even safe assets can be in the middle of a stress episode. I think that's the first conclusion. Second conclusion is, actually, yes, we do worry about these non-banks. Yes, hedge funds have become very important. They are now the marginal buyers of treasuries. But what really enables those hedge funds are the banks. Without the banks, they would not be able to get the leverage. The vast majority of the repos are actually bilateral repos that come through the banking sector. So we talk a lot about the non-banks these days, the NBFIs, the non-bank financial intermediaries. Well, actually, the motto has to be, the more you worry about the non-banks, the more you have to worry about the banks, because it's the banks that are actually enabling those non-banks. So I think, Harold, I think this is a good point where I think we can switch to the Q&A.
The first worried question is, one of the constructions that we saw in terms of thinking about the post-global financial crisis story was the interlinkage of bank worries and sovereign debt worries. And it seems to me that you've got a version of that in a particularly dramatic form that you're conjuring up again. And in that sense, you've got structurally a similar issue, that if you think of big problems in this banking sector, they're clearly big fiscal problems as well. Is that correct?
I think that's fair. So clearly, it's the fiscal element which is behind the very rapid rise in lending to the governments and the bond market. So we tend to sort of put that to one side because government bonds, they're safe, they're liquid, but even safe securities can be at the center of a stress event. And we talked about, Julia talked about mortgages earlier. Imagine that you have something happening in the bond market that leads to a very sharp steepening of the yield curve. Well, if the 30-year treasury rate were to go up a very substantial amount, that's going to have a direct impact on mortgages, on the mortgage rate as well. So it's not default that is going to cause the problems. It's much more that financial conditions will affect the economy through the standard macro channels. But those can be just as painful.
I see some questions already. Marcus.
Yes, several. I was wondering whether you see QE now in a different light. Is QE like a Hotel California? You can do it, but you can't get out of it anymore. So you increase the central bank balance sheet. But to undo it, you will create some financial instabilities on the non-bank financial and bank financial side. My second question is, isn't this all driven purely by liquidity regulation? The banks that don't want to buy these government bonds back when the Fed is undoing QE to QT, because they have to suddenly come up with some capital requirements or some equity requirements. And if we relax the liquidity requirements, the new liquidity regulation we imposed after the global financial crisis, then they wouldn't do this shifting it off to non-bank financial institutions with the repo arrangement. So perhaps we can just easily fix it by correcting some regulation. And the third question is, the initial slide you've shown that the public debt went up so much. Do you view now the German debt brake differently? Because when we met 5 years ago or 10 years ago, everybody was saying, yes, everybody, government debt is so cheap, they should issue the government debt and government debt. And now we have a lot of government debt. Perhaps it was not the wisest thing to do so. Perhaps I sound too German in this regard.
Very good, thank you, Marcus. So you asked 3 very good questions. And Marcus, the microphone wasn't working when you asked the first question. So let me just repeat that for the benefit of people who are listening in. So Marcus's first question was, is QE a bit like Hotel California? You can leave, but you can never. You can check out, but you can never leave. I think what you saw in the charts is that there is very much a ratchet effect. So deposits are a very good indicator of how much the alternative buyers are actually operating. So if you just juxtapose the central bank's balance sheet with the amount of deposits in the system, that gives you a sense of the wedge that must be taken up by the alternative holders. I think what is true is that short-term funding conditions are extremely accommodative. So the zero haircuts are just a symptom of that. And when people in the markets, and Joyce Chang is here, when people in the markets talk about there is plenty of liquidity sloshing around, that's what people mean, that you can get credit very cheaply, haircuts are zero, short-term funding is extremely accessible. And I think in that sense, it was quite natural that it's the short-term borrowers, in particular the repo-funded traders who would take up the amount of bonds that are actually released because the central bank is not buying and is allowing the bonds to roll off. Is banking regulation to blame? Well, I don't think so, because the banks were never huge holders of government bonds in the first place. And so I think the ideal would have been that if we did QT, the system would go back somehow to the pre-QE state. But clearly, once you've started something, you've set in motion these other forces, which mean that it's very difficult to go back. It's very difficult to turn back the clock. Now, was QE a mistake? Well, no, because you really needed that at the time. Otherwise, the system was on the brink of, some existential crisis. Then what is the conclusion? Well, I think the conclusion is that the original sin was in allowing the GFC. I think that is the original. That is the conclusion. I think we should not have allowed the GFC. But having allowed the GFC, we are in this, we're on this path. But can we retrieve the situation? I think, we can do our best, actually, to get back to something which would minimize, the vulnerabilities. But it's going to be a combination of regulation, but also, I think, an understanding of the system itself. And your question about Germany, of course, R minus G can be negative, but that doesn't mean that it's free. Because fiscal space is something that is always there until suddenly R minus G becomes positive. And so I guess the way that I would put it is it seemed as if there was plenty of fiscal space. But well before you reach the theoretical limits of fiscal sustainability, financial stability, problems will kick in. And so, R minus G was negative for a while, but then suddenly, it flips. So, but I won't directly answer your question, otherwise I'd be picking sides here.
Okay. Yes, please.
Hello, thank you for speaking today. I actually wanted to ask a question that was posed by Hanno Lustig a couple months ago, and regarding the pickup of treasuries by hedge funds, especially financed by repos. We've seen, especially recently, that the Fed has been very quick to intervene in repo markets when there has been some turbulence, and the Fed is actually buying treasury assets right now. And the question he posed is, given this framework, do you think it's possible for the Fed to set its balance sheet independently of treasury issuance? And another thing I wonder is this the doorstep of fiscal dominance?
I think that's a very good question. Why don't we take Atif's question as well, and then I can maybe combine the two. Yeah.
Yeah, Atif then.
I want you to go a bit deeper into what you mean by it's the original sin is the GFC, because what's the counterfactual? When you showed the first chart of private credit growing and then goes down, but then government debt starts to rise. Presumably there are some structural forces in the real economy that are driving those. I mean, that's what I would say, because these are big numbers. It's happening for sustained periods of time. So the GFC itself is driven by some of the excesses in the private credit market, which is presumably why it stops growing afterwards. Do you have a speculation on what's going on and what the counterfactual would be if you were to try to tame it ex ante?
Yeah, and I want to take it back to some of the charts that Shebnam showed us yesterday, which is, of course, the period before the GFC was a very special period because it was clearly a period when it was a private sector lending that was, it was the lending to the private sector that was really growing very rapidly. And what Harold refers to in his introduction are those early analyses that we did here, actually. And Marcus was very much part of this endeavor as well, where we just showed that these private sector balances were growing really too fast. And it was sort of injecting all of this complexity. And so I think the question is, could there have been some other remedial measures that actually could lean against that? Even before then, if you look at some of the proceedings of the Jackson Hole conference, late 90s, early 2000s, of course, there was a lot of debate about the growth of credit. Should central banks worry about asset prices? And I think there was a sense, very much a sense that those things shouldn't really worry central banks too much, because it's always possible to intervene, and then you can always go in and clear up. Also, think about what was being discussed in the height of the GFC, and central banks were beginning the asset purchase programs. Of course, the exit was not really thought of as being that difficult. It was going to be, of course, there may be some procedural issues, but it should be relatively easy to undo all of that. But I think in practice, what we're seeing is, of course, is that we probably underestimated the difficulty in extricating ourselves, in that process. So certainly in the heat of the crisis, clearly, you have to intervene. And it's the buy of last resort role of the central bank, which is going to be extremely important. But should central banks have continue to buy assets for monetary policy reasons? I think that's much more subject to debate, actually, because if it's purely to keep long-term rates low rather than address financial stress, I think that's there's more room for debate on that score. So I think that's how I would answer the question. The early 2000s would be, I think, the really pivotal period. Could we have done something that addressed the build-up of the big credit boom leading up to the GFC? Because if we could have, that would really make our lives a lot easier, even today. We don't have to worry about some of the things that I showed you.
So Linda, go back.
Yeah, so I want to tie a little bit some of your slides back to the topic of Ken Rogoff from yesterday. So you showed that official holdings of U.S. government debt flattened out around 2012. And, so that's overall stayed the same. We also know that the dollar share of foreign exchange reserves locally peaked around 2015, and that a good chunk of whatever's come down since that time is associated with some combination of China, India, Russia divesting of U.S. Treasuries. So their reserve holdings and then their allocations to Treasuries have come down a lot, and that is also pulling down what appears to be the dollar share of official reserves. So while we talk about things like regulation as potentially having consequences for all of these dynamics, what role does this kind of reallocation of foreign portfolios concentrated in a limited number of players due to the dynamics of treasury markets?
I think that really is the most important question, Linda. So, one of the potential buyers of treasuries when central banks were, shrinking their balance sheets, of course, were the official holders. But the official holders have not stepped up to the plate. And so it's been left to the private sector holders to actually absorb. So in that respect, I think it's played a very, very important role. And of course, the events of the last couple of years have certainly, reinforced those trends.
So, yes, please.
A great presentation. I just had a sort of a question on the mechanics of part of your story, if you could just kind of help me think through it. So you say that when the central bank does QE, commercial banks will expand deposits, and those will be held by non-banks. And then in your story, it sort of stops there. But you could play it further and say, well, the non-banks could do other things with those funds. Why do they have to stay in the banking system? And so it seems to me, perhaps another story is that at the same time there is lots of demand for these types of different assets. And so it's not, that sort of would explain the confluence of these two factors at the same time. So I was wondering what your view on that is.
So that's a great question, Emil. So what I haven't done is to, give you the kind of wiring diagrams that we used to have. Do you remember that New York Fed diagram of all the special purpose vehicles in the run-up? I didn't show you what the money market funds were doing. I didn't show you what the central clearing, infrastructure was doing. This was a highly sort of, highly simplified chart. So there's clearly a lot more that's going on, and simply showing that the initial impulse is for the deposits to increase doesn't mean that it will just freeze there and it'll be unchanged. But certainly what is true is that if you're holding a very, very large amount of very liquid claims, then that does have an impact on financial conditions. And if you think about the repo haircuts, for example, I think we have to attribute some of that the erosion of the haircut numbers to the very ample funding that's available. So it's not the same as what happened during the run-ups to GFC, with all of these very, very highly leveraged private sector institutions, but still the asset holdings have been highly liquefied, if you like, and that has an impact on financial conditions. So and this is in spite of the fact that when stress hits, it's the banking sector that's going to be the driver of those financial conditions.
So we're gradually running out of time, but yes, please.
Hyun, thank you for an excellent presentation and for really laying out, I think, the right diagnostic of the problem. But I want to ask you really more about the non-bank participation, because I don't think you can separate it from the banks. But as you say, the banks don't own a lot of treasuries and don't need to buy treasuries. They at this stage, no matter what happens with the SLR reform. So my question is, our calculation of the Treasury funding gap to the end of the decade is probably about $5.5 trillion if the fiscal stays where it's at, and that the Treasury will have to increase the coupon and the auction size by next February at the latest, 1 year from now, significantly. So given that, though, the non-banks are the holders and will be the source of the volatility, I mean, what is the right regulatory response? And maybe to link it back to Michael's point as well, like, you know, it isn't about the bank regulation at the stage in the game. So if you're talking about capital controls, how do you actually look at this from a regulatory perspective with respect to what works? And then if you lay out the problem, as you have to people at US Treasury, they give you the answer that, oh, stablecoin will save the day because it'll buy all the treasuries. What work have you done looking at the stablecoin? We use a far lower number than Treasury on the stablecoin demand for Treasury, but what work have you done on the stablecoin demand?
So Joyce, you've said the magic word because I won't say too much about stablecoins. Except to note that stablecoins are still very small relative to the amount of treasuries outstanding, and in particular, it's going to be very much. I mean, the amount of stablecoins outstanding are around 300 billion. The treasury market is, many multiples larger.
3 trillion. We're using 650
Yeah.
billion at JP Morgan by the end of Trump's term, not in a year.
Yeah. I think your question about what are the regulatory responses that could be deployed here, I think that really is the important question. And I think the short answer is that there are not many very good options. I think one thing that is on the books but have not really been used is some kind of minimum haircut. Minimum haircut limits for repos. That is on the books and in the sense that it's part of the Basel III toolkit, but it's never really been used. But clearly, that's going to be a very blunt instrument, and it, if the underlying market conditions are so accommodative, just putting a limit will just mean that there's plenty of scope for circumvention of those rules. But clearly, it's the fiscal trajectory which is going to be absolutely crucial to this, because someone has to buy it. Why have Treasury yields been so stable? And in fact, it's actually lower now. The point with hedge funds are that they're not very price sensitive. They are spread sensitive, but they're not very price sensitive. What they care about, of course, is the difference in the yield, as an asset versus the yield on the hedging instrument. And what has been true is that the convenience yield on treasuries have fallen dramatically, and what we see is that, in fact, the convenience yield has become not only small but actually negative, in the sense that the swap spread, the difference between the treasury yield and the interest rate spread, the pay fixed portion of an interest rate swap has flipped, in the sense that you pay less for a private sector interest rate swap than you would, getting in terms of the yield on the treasuries. But for a relative value player, of course, that matters less. So the actual level of the yield, matters less. And so I think that's probably one explanation as to why we have not seen a bigger increase in the yield.
Yes, the very last question, please.
Is there time for that?
I of course, yes.
Thank you. As a non-bank entity, I worried a lot about the unknowns, and in this connection, it's the next financial crisis. We know that the 2008 GFC was because of the credit default swaps, subprime mortgages, a lot of the banking system failure. And the remedy to that was Sarbanes-Oxley. So I guess my question is twofold. Number one is, do you see any risk, danger, or potential of the next global financial crisis? And where would that be? Would it be in the U.S.? And because I'm afraid it could be in the U.S. because of this huge AI sector investment that they want to make in the face of very uncertain returns. Where would the revenues come from? Nobody knows. That's the known unknown, right? And so then the question is, I remember that Sarbanes-Oxley, the Volcker rule, the Sarbanes-Oxley, and Paul actually said that Sarbanes-Oxley didn't go far enough. His original proposal had been stricter in terms of banking regulation, but it didn't get past Congress. And so do you think it's time that Sarbanes-Oxley be revisited?
So May, thank you for that question. I think you mean Dodd-Frank rather than Sarbanes-Oxley. Yeah, Dodd-Frank. But I think, of course, at the BIS, we always worry. As Harold says, if you just step into our door, and Linda knows this very well because Linda comes to our meetings very regularly, we have a big sign promoting global monetary and financial stability. That's our mission. So as part of that, we always worry. So that's the first part. Of course, we also host the Basel Committee on Banking Supervision. And although bank regulation has not always been the most popular in financial circles, I think it's done a good job. And there's always scope. There's always scope to see if we can improve it further. I think that's probably the most I can say, at least while it's being recorded, actually.
Thank you so much.
Thank you very much, Hyun and Harold. So with that, we come to a close. I just want to thank all the speakers, the moderators, and of course, all of you who are in attendance. The last 24 hours, it at times felt like trying to drink from a fire hose. So there was a lot to absorb, and I'm sure each of the sessions and the keynotes, we could have doubled the time for discussion and all of that. But keep some of those ideas and thoughts for our next year's conference, and I hope to see many of you back. But this is not Hotel California. You can also leave. I wish all of you a safe journey back home and safe travels. Bye-bye. Let me just thank Pallavi Nuka and Nancy Turco for organizing everything.